Hello, happy Friday. Welcome back to another episode of Fridays with Flo. And today we're going to be talking about cash flow versus appreciation. Which one actually builds wealth? I think the first thing to start here with is understanding the difference between cash flow and appreciation. So, we're talking about the world of being an investor and what it really looks like when you have investment properties. So far this year on this series, we talked about selling, preparing to sell for top dollar, had conversations with appraisers. And as of the last episode, last Friday, and today's episode, we're talking about cash flow, appreciation, building wealth through investment properties. So, kind of a little bit different feel here, as I am both a licensed real estate broker and investor. So, today we're really getting into it. Okay, breaking down cash flow and what it really means now. So, cash flow is your income flow. This is the profit that you make after you have paid off your mortgage. So, starting from the basics, you have an investment property, you have a tenant in there, and somebody is renting it from you. And so, when you collect rent every month, ideally the home is able to be paid off for the mortgage every month, as well as any other fees such as an HOA. If you are including utilities in the rent agreement, anything that you are including in the coverage, internet, those types of things, once all of those are paid off, the difference that's left from the rental amount is your cash flow. So, for example, in terms of numbers, let's just say your mortgage on this home is $1,500. Your HOA fee is $50 a month. Although those are quite rare, they are still out there. And maybe you don't include any other utilities. The tenant is on their own for that. So altogether, between the mortgage payment and the HOA due, you're at $1,550 per month. And let's just say that you're collecting $1,750 per month in rent. So $1,750 minus $1,550, that $200 difference is your cash flow. This is your monthly profit after expenses. This helps you cover other types of debt that you might have. It might help you reinvest. The smartest thing to do with it is just to store it in a savings account for that property, so that whenever anything might come up, like repairs, something's leaking, something's broken, maybe an update needs to be done, you can kind of go into that fund that you've been storing every month. Now, as an investor, you might look at buying investment properties for the goal of cash flow. Maybe you're like, I don't want that property if it's not going to cash flow me at least $500. Some people say if it's not going to cash flow me at least $1,000. It's kind of tough to do that depending on the market that you're looking at investing in, as there's a lot of factors that's involved here, between slightly higher interest rates, the cost of housing being more expensive than it was, several years ago. So tackling those two right there can make it a little challenging to truly cash flow amounts as large as $1,000 a month for a single family. But if you're looking at a multi-family property, this might be a bit more viable, because one door might pay the full mortgage, right? Or at least half of the second door's rent might be able to cover. Between the first door and half of the second door, that rental income that you're getting, it might cover all of it. Let's just say, for example, you might have a triplex, and for the triplex, maybe the mortgage payment on that is $2,500 a month. And so if you're collecting $1,500 per door, so 1,500 times 3, 4,500. If the mortgage payment on that triplex is 2,500 and you are making a total of $4,500 a month for this triplex, then 4,500 minus 2,500 leaves you $2,000. Now, ideally, all of those tenants are on their own for utilities. Of course, most duplexes or triplexes, those types of units are not typically in HOA areas. So if you are self-managing, you have no other fees besides that mortgage payment, and you're not including any utilities with that, essentially you are truly cash flowing $2,000. You're profiting $2,000 per month on this investment property. Right. So this makes more sense as far as getting a higher amount in cash flow when you're looking at multiple doors versus one rental income, which is pretty much trying to cover the entire mortgage payment and any other dues that might come with that. So cash flow overall pays you today, whereas the second thing we're talking about is appreciation. Appreciation is wealth over time. This is the main reason why most people invest in real estate. The idea is you buy it today at $100,000 and prayerfully in the next several years, eventually it'll be worth $200,000, right? That is the goal. And oftentimes real estate appreciates. And even when the market slightly adjusts, the economy's experiencing a little bit of a, downturn, you can expect the economy to pick back up and real estate to also pick back up. One thing anybody's always going to need, everyone's always going to need, is a roof over their head. So if you're thinking about investing in real estate and you're not 100% confident that investing is the right decision for you, I highly recommend you consider all the avenues. For a lot of people, a lot of investors, they might invest in real estate for the sake of appreciation only. Maybe they're like, I don't really care for cash flow. If I'm cash flowing $100 a month, I'm okay with that. So long as that mortgage payment is paid off every month, I'm good with it. Whereas some people might say, no, I need it to bring me money every month, And so there's different strategies that might matter for different types of investment properties. So with appreciation, this is property value increasing over the years. It also means that you're building equity passively. So when a tenant is renting that property from you and you're collecting rent every month and the mortgage payment is being covered, with every month's rent collection, over the years, you're also getting a property that is being progressively paid off through the rental payments, right? And so not only is it being progressively paid off, it also means that over time, the property value is increasing as well. Now, appreciation, it will depend on the market. Other factors such as job opportunities coming to the area, any other factors of growth, migration, or, folks moving in versus folks moving out, that's not helpful. When people are leaving the area, that's going to negatively impact the neighborhood and home values. Whereas when people are moving in, that's going to drive up home values. That's going to drive up demand and interest. That's typically what you want in investment property, and in order to help it actually appreciate over time as well. So for those who are interested in both cash flow and appreciation, you can, but you just got to do a lot of deep research to make sure that you're going to be able to get both. There are some investors who are purchasing things like your mobile home parks. Those are not going to appreciate in value. Mobile homes are not real estate. They're mobile. They come with VIN numbers like cars do. Typically, they do not appreciate over time. Value stays the same. Somebody who might buy a mobile home park is entirely focused on cash flow. And mobile home parks are actually considered cash cows, which means they bring in a ton of cash. That's really what it means, because imagine you have 30 mobile homes in the area on your land. And between those 30 mobile homes, let's just say you're renting each out at $1,000 a month. That is $30,000 that you're making every month. If rent is $1,500 a month or more, than great. You're making more money than we're calculating here. So just understanding that different types of investments might yield different things, and you might choose to go a different route based on what your needs are and what your goals are. If you're looking for money further down the line, then appreciation might be the direction that you're looking for. You don't care too much about how much money it's going to bring you now, versus if you're looking for money now, you want some extra income to come into your pocket every month, then cash flow is going to be your focus. All right. Now, the third thing to keep in mind here is that some markets might favor one more than the other. And we've kind of touched on this a little bit. For markets where you're going to see more favorable homes, like better schools district, you're going to see a lot more like corporate companies coming in, like Amazon, Apple, Google, those folks coming in and kind of establishing headquarters or warehouses or investing in the area, you're going to see a lot more rental demand as well. And it also means that you're going to see a lot more appreciation on the house, because most folks might be coming in to settle in areas where there is a level of nightlife, there's amenities, there's access to not just living, but also things to do. People might leave other more expensive states to move to a place like that. North Carolina is one of those states. For North Carolinians, we thought life was okay, just fine, until we ranked top 3 in the country of places to move to literally since COVID. Since 2020, year after year, we've ranked top 3 and we remain on top 10 states to move to for the last 5 years at this point. And so much of that is because you do get access to kind of like a little bit of a metro life, whether you're in Charlotte, Raleigh, Greensboro. It's not too fast paced, but we're also getting an increase of that Atlanta, Georgia traffic. Things have shifted, and it also means home values have increased too. The cost of living has increased for a lot of people. Rent have increased. So our kind of market, it's a really great market to invest in because you're going to get both appreciation and cash flow depending on what type of asset you're buying. Again, I'm going to continue to reiterate that because buying a condo, single family versus a duplex, triplex, multifamily, or apartment complex, your cash flow is going to look differently, and the cost of acquiring that investment property is going to look differently too. In markets where it's a highly renters market and there's not a lot going on, not a lot of job opportunities coming to the area, then in those scenarios, you're going to deal with appreciation being really slow. And we have those markets across North Carolina. So there's some markets within North Carolina that might favor more appreciation of the property. And there's some markets within North Carolina where appreciation is very slow. One of those areas is Rocky Mount, North Carolina, where today you could still go buy a single family house over there for $60,000, $70,000. You can still do that today in 2026. That's a huge indicator of a slower appreciating market. And it's because there's not a ton of movement happening there. For some folks, it might be considered a ghost town. And also, there's a lot of other things included, such as most people that live there rent versus owning. And so when most people rent, then that means not a lot of sales are happening. So the way to determine a home's value is typically by looking at what other homes in the neighborhood has sold. And so we don't have enough homes in the neighborhood to indicate, hey, this value has increased or this value is this. And we're looking at old data since the last home that sold in this neighborhood sold 3 years ago. That can stifle the value. So the appraiser is really looking at the condition of the home. It's a real problem. So those are some things to kind of consider. Now, cash flow does protect you during tough markets. When the economy is on a slight downturn, it allows you to still be able to not only cover the mortgage payment, but even take care of some of your own personal expenses in those kind of like rough, bumpy economic flows that some might already be experiencing in 2026. So we're seeing a lot of that now, and more rentals are having to reduce price on the rental amount just to get a tenant in there. Home sales and purchases are also doing some slight reductions on price as well. So we're kind of seeing that. And, when we go through those time frames, right now, don't count on appreciation a whole lot across the board. It doesn't mean that it's not happening. It's still happening. It's just not happening as much as, for example, from 2020 through 2023, for example, when home prices skyrocketed and people saw their home value doubled over the span of a year or two. So that is the fourth thing to consider. Now, the final, very last thing to consider is that the best deals often have balance. That is my favorite way to go about things. If I can buy an investment property that is both going to cash flow and appreciate, that's really what I'm going to go for. And strong investors look for both whenever possible. So for me, that means I'm looking at markets that are typically kind of like the metro areas, or at least very close to the metro areas, because that at least over time, I can expect that when the metro areas get too expensive, people are going to want to move 15, 20, 30 minutes out versus an hour out. And those markets might be a little bit more stifling with appreciation, understanding that people are also willing to drive 30 minutes to work if they have to move further out for more affordability. So if I'm investing and expecting appreciation and cash flow, I'm going to start within the center of population and opportunities. And then I'm going to go at least 30 minutes out of that if I'm looking for something a bit more affordable as an investment property to be able to get both cash flow and appreciation. So in the long run here, cash flow versus appreciation, which one being better to build wealth? Both eventually. So not necessarily one more so than the other. It really depends on what do you need. If you are older and nearing retirement, you might consider cash flow might be more important to you. Whereas somebody who is in their 20s and 30s, they still got a little bit more time. They might focus more on appreciation because they know that even though if they're not collecting a lot of money now, so long as the property is going to appreciate in value, by the time that they get to the point of retirement, the home will not only be paid off, it'll also be worth way more than what they bought it for. And that is essentially what they're going for. Being able to collect rent on a fully paid off property, where somebody that's near retirement, you're counting on that additional income to help you save towards retirement closer or more, right? So definitely some different factors to consider here. I would love to hear some of your thoughts on today's session in the comments, and any questions you guys have, you can tune in and follow me on I'm Flo the Realtor on Instagram, Facebook, and YouTube, and as well as LinkedIn. So follow me on social media. If you are tuning in from YouTube, please do comment, like, and subscribe, and I will see you guys next Friday for our next session. Have a good one, y'all.